If you've been frustrated that the markets and some of your favorite stocks haven't been doing anything for some months now, we're going to be talking about a strategy today that lets you make money even when the market's doing absolutely nothing, trading sideways, or even slowly drifting lower like it has been over the past few weeks. Now, I could walk through this alone, but I've got someone here that keeps me sharp, asks the questions that you're thinking, and calls me out if something doesn't make sense. Everybody say hello to my daughter and Ivana from Investing with EG.
Hi everyone, I'm Ivana, and yes, I will definitely call him out. That's obviously my job, and even at home. Jokes apart, we're going to break down everything together so it makes sense. No fluff, just the real strategy with real numbers that absolutely anyone can follow.
So let's start with the basic facts. The truth is, markets don't always go up. Sometimes they go down or just move sideways for an extended period of time.
But what happens when a stock just sits there and does nothing? That's when most traders get stuck and start feeling frustrated.
So here's the answer to that. In times where the market feels stuck or slightly bearish, we focus on a strategy called the call credit spread, also known as the bear call spread. In this option strategy, you sell a call option at a lower strike price, and at the same time, you buy another call option at a higher strike price. Same stock, same expiration, both placed together. And because you're selling the spread for a credit, money comes into your account right away. And one of the main reasons why I like this strategy is that your max loss and profit is clearly defined at the time of opening the trade.
So credit means we get paid up front.
Exactly. The premium you collect is your max profit. So as long as the stock remains below your short call strike price, which is basically the sold call, then you get to keep that entire premium. So basically, we're betting that the stock can go lower, stay sideways, or even go slightly higher, just not reach the strike price of our short call. So for example, let's talk about Nvidia. Huge name, massive AI run up, but for the past 6 months, the stock's been telling a different story. It's been consolidating, struggling to break higher, and moving sideways for quite some time.
Yup, to be honest, it's been extremely boring, but not in a bad way. I mean, it ran up so much and now it's just stuck in like a range, up a little, down a little, and it just keeps repeating the same pattern.
And that's why Nvidia is the perfect stock for this strategy. Nvidia is trading around $173 after pulling back slightly over the past few days along with the rest of the market. So if I believe that Nvidia is going to continue to trade sideways or range bound over the next few weeks, I would consider opening a call credit spread on it.
We don't need any big, dramatic change. We just need the stock not to break above our level.
You said it. That's exactly the beauty of this strategy. We don't need anything dramatic to happen. We just need the stock not to break above our level. So if we check out the Nvidia chart for the past 6 months, you can see that going back to November all the way through March of 2026, Nvidia has been trading mostly sideways with about $195 on the top right here, and on the bottom getting down to about $170. So it's been mostly range bound in this $25 range for quite some time. Also, if you check out the RSI is close to 37, which means that Nvidia is obviously in a bearish state as we speak. So it meets the criteria that we're looking for to open a call credit spread. So next, I'm going to pull up the options chain and go out 33 days to the April 24th, 2026 options chain. So as we saw from Nvidia's chart, the 195 strike price serves as a strong level of resistance for Nvidia. So keeping that in mind, if we check out the 195 strike price, this is a delta of 15, meaning that there's only a 15% chance of Nvidia getting to this price point by our expiration date. So keeping that in mind, I'm going to open up a call credit spread. I'm going to sell the 195 strike price call option by clicking on the bid. So as you can see, the order ticket's now open and we're selling the 195 strike price call option. So to build a call credit spread, we also have to buy a call option for the same expiration date. And depending upon how much risk you want to take, you could open up a $5 spread or a $10 spread. So in this case, I'm going to go with the $5 spread. So Ivana, which strike price should we be buying now to build a $5 spread since we sold the 195 strike price?
We now have to buy the $200 call option to complete the spread.
Exactly. So I'm going to go ahead and select the $200 strike price. And as you can see right now, what is the credit that we're receiving to open the spread?
50 cents, which means $50.
And why is that?
One options contract equals 100 shares, so you multiply the 50 cents by 100 to get to $50. Another thing I want to mention is that we don't always have to pick the 15 delta. It's just that the higher delta you pick, the more risk you're putting in, but also the more money you receive. If we went with the 0.10 delta, we would have less risk, but we would also make less money. Versus if we would go to the 0.20 delta, we would make more money, but have a significantly more risk.
That's exactly right. Anytime I open up a spread, I like to go with the lower delta because that means that there's less chances of the stock getting to my price by the expiration date. And even if I receive a lower premium compared to a higher delta, I'm okay with that because it also means that there are higher chances of me ending up winning that trade versus going with a higher delta and possibly the stock breaching my price.
In simpler words, he doesn't want his greed to get to him and he doesn't want to end up risking everything just to lose it all.
That's exactly my thought process behind going with the lower delta.
So net, we keep 50 cents or $50 per contract right away.
That's exactly right. You collect the premium as soon as you open the trade. And in this case, the $50 is our max profit. If Nvidia stays below the 195 strike price, we get to keep the entire $50.
What about our max loss on the trade?
So since we have a $5 spread, the max loss on a trade would be the $500 collateral that we would have to put up to open this trade, less the $50 premium that we're receiving. So all in all, you're risking $450 on this trade.
Now let's look at a $10 spread and see how the premiums would change.
So in case we want to do a $10 spread, in case of buying the $200 call option, we can buy the 205 call option, and that would make this trade a $10 spread. So I'm going to go ahead and select 205 right here. So Ivana, I just changed this trade to a $10 spread. And what happened to the premium now?
The premium increased.
So what's our new premium amount?
$77.
Exactly. So we now collect $77 to open a $10 wide spread instead of the $50 that we were collecting with a $5 spread. So Ivana, now that we have a $10 spread, what happens to the collateral that we need for this trade and our max loss?
So now we need $1,000 in collateral and not $500 since it's a $10 spread, and our max loss jumps to $923, which is 1,000 minus 77.
I was going to ask you, but you already answered my question. That's great. So again, the max loss in this case, since we have a $1,000 collateral, is taking the $77 premium that we're receiving and subtracting it out of the $1,000, and then we're left with a max loss of $923 on this trade.
So at the end of the day, the best person to decide what's the right choice for you is you. Neither is right or wrong, and it totally just depends on your comfort level and your strategy.
So if you check out this diagram right here, as long as Nvidia continues to trade under $195, which is this green zone right here, then we get to pocket our entire premium. So Ivana, what happens if Nvidia starts getting to this red zone right here?
The red zone is where we start losing money, and the max loss would be 205 or higher if we go with the $10 wide spread.
That sounds right, but if you notice where Nvidia is trading right now, it's trading around $173. So that means Nvidia has to make a considerable move to get to the 195 strike price by our expiration date. Now, another thing to keep in mind is that timing also matters. We chose 34 days because that's when time decay starts working heavily in our favor.
So time is literally helping us make money.
Exactly. And we don't want to hold our trade until expiration. We usually want to close our trade anywhere from 50 to 70% profit because you want to lock in your profits, free up your capital, and then move on to the next trade.
And what happens if the trade goes against us?
So if the trade starts going against us, we want to cut it out early. My rule of thumb is that if the trade gets to 2x the credit that I originally received at the time of opening the trade, then I would go ahead and exit the trade. So for example, if I collected $77 at the time of opening the trade, I would simply exit the trade when my loss is a negative $144.
It's 154 actually. So I think he needs to get his math skills up because he can't do simple addition, but anyway, a call credit spread lets you profit when the stock is bearish or sideways. You collect premium up front and define your risk immediately. It's simple, repeatable, and powerful when used correctly. We showed 2 real trades today, both based on the same idea but different risk levels, different rewards, but the same core strategy.
That's right. You just need discipline in your execution and need to know if it's the correct time to deploy the option strategy that you're interested in.
That's it for today's video. If this helped you, hit that button and subscribe to our channels and comment down below with your thoughts or any questions.
We'll see you in the next one.
Thanks for listening.